Hi, Mark. Welcome to Options Brew, Stock and Options Minutes with Mark and Lex.
Lex, how are you doing today?
Good. I changed the title. What do you think? It's
I
different.
like it.
Yeah,
I,
it's
I'm
okay. Today we're going to take kind of a little bit more basic approach to something that we learned, Mark and I learned from the trading floor and from our mentors, and it's called synthetics. Okay, and we're going to show the relationships of calls and puts in stock and all the mathematics behind it. Now, mathematics, when I say that, don't get crazy frightened. It's not very deep. It's just that what you have to know, how these relationships must exist, right? Otherwise, there's an arbitrage opportunity, and the citadels and market makers like we used to be would take advantage of it, right?
exactly. This is the bedrock of pricing. This is, this is how you make sense of the price of calls and puts in a given marketplace.
That's right.
Your fundamental relationship should be.
That's right. Okay, good. And if viewers have a question, I encourage you to type it in the chat, which I'm going to get up now, put up now so I can see it. And we will answer your questions. So we're going to take about 10-ish, 15 minutes here and go through what we call synthetics. Mark, go ahead, take it over. I think you're going to share a screen probably, right?
Well, I'm actually going to pull out the whiteboard that's, it sits in the back and I don't think I get enough use of it. And so
Okay,
I figured
I like
that
it.
synthetics, this is perfect. This is perfect for the whiteboard.
Okay, go.
So it all comes down to four letters, right? Put call parity is, there are a lot of different formulas. There are a lot of different ways you can arrange it, but this is the way I was taught. This is the way I'm always going to think about it. But it's call minus put equals stock minus strike.
Okay, so C minus P, call minus put equals stock minus X, which is strike in your equation there.
Exactly. And like I said, there are a lot of different ways to denote this. There are a lot of different, reformulations, but this is how I think about it. And it's saying that the price of the call minus the price of the put is equal to the forward value of stock, and I'll get into that in just a sec, minus the strike price.
Okay.
So what you're saying is that on the same strike, the call and the put are going to have a proportional value. They're both going to be affected by volatility the same way. Mm-hmm. And by adjusting for stock, and like we'll get into some of the synthetics later, we can see that a call is a put and a put is a call.
Right. Got it. Perfect. Go ahead.
So looking at market prices, you can take the call, you can take the put, but I want to dig into the forward value of the stock there for just a minute, because it's not just what the stock is trading for right now. You have to take into account the forward value, because remember this is pricing the option at expiration. Mm-hmm. So we care about what that stock will be worth at expiration. And there are two components that go into the forward value of the stock here. And they're going to be the interest rate, the risk-free interest rate, and they're going to be the dividend. To the extent that the stock is paying a dividend, you have to take that into account for the forward value, because option holders don't get the dividend. Stockholders get the dividend, but a dividend shouldn't be included in the price of an option. And the forward value of the stock will reflect the fact that that dividend has been paid, prior to expiration.
Correct. Okay. What are we looking at, a particular month, or is this just an illustrative example here?
So this example I have pulled up is for McDonald's, ticker MCD.
Okay.
And I picked them because they happen to have a dividend. Actually, they're going ex-dividend tomorrow.
Okay. So it's this May 28th weekly that we're looking at. Is that right?
I was actually looking at the June one that was 8 days away, because I wanted to give it a little bit of interest rate value.
Got it. Okay. I'm just pulling it up so I can follow along. Go ahead.
Yep. So perfect. If you're following along, I'm looking at the June 4 expiration in McDonald's, 8 days away, the 232 strike.
Okay.
And these numbers were actually snapshotted a little bit earlier. Stock's probably down 60 cents since I did that, so it's not perfect, but this will work no matter what the stock price is.
Okay.
So like I mentioned there, McDonald's has a dividend going, or they're going ex-dividend tomorrow, which means if you are a shareholder of record as of tomorrow, you will be entitled to receive the dividend. And the dividend is this D value, $1.29.
Okay, let me interrupt. We have a question from the audience. So the question is, what does that equation represent? So what it represents is, if you take the call, the premium of the call, and I think we're going to use midpoint values just to illustrate. If you take the premium of the call, okay, again, midpoint, minus the premium of the put. Now, when I say premium, I mean the market. So whatever the market is, and you subtract the call minus the put, okay, and you compare it to the stock price minus the strike price. Those values, including interest and dividends, must be equal. If they are not equal, there's an arbitrage opportunity, okay? Because what we'll learn in a second is a long call and a short put on the same strike in a 1-to-1 ratio is equivalent to being long the stock. It's called a synthetic long stock position, okay? So let's go at the same strike is correct, right? Okay, Mark, go ahead.
So yes, so we have this dividend going, ex-dividend tomorrow, paid to the owners of McDonald's stock. But then the interest rate is the other component that you need to know to evaluate the forward value of the stock, what that stock will be worth on expiration on June 4th.
Mm-hmm.
And so we take the risk-free interest rate, sort of for simplicity's sake here, I assume the risk-free interest rate is about 1%. So to calculate what that interest value is going to be in dollar terms, because I want to adjust this forward value down, I'm going to do 8 days divided by 365 days in a year. That's about 2%. And then I'm going to multiply 2% of 1% and end up with about 2 basis points. So it's about 2 basis points of interest. That doesn't sound like much, but we multiply that by the price of stock, 233.35, and we get about a nickel. So there's actually going to be about a nickel of a forward value that we're going to add to the stock,
Mm-hmm.
and then we're going to subtract the dividend from that.
Yeah. So let me break in here too and explain something. The reason that's when we're doing this spread, right? If you're going to be long the stock, you're going to pay that amount, that nickel. It's going to cost you to carry that. Most folks in the retail world don't realize that. When you own stock or your long option value versus short option value, that net number is a charge to you. Okay. That costs you something to carry that. It's called carry cost, right? So that nickel is something that you actually pay. Now, most of you probably never even see it because you might not be into positions very long. You're in and out of these things, but it is in fact a cost, right? Agreed, Mark?
Absolutely. I mean, this option is only expiring in 8 days, and interest rates are as low as they are. I picked 1%, but if interest rates start to become material and your positions start to become bigger, these values really compound, and like you say, can be very meaningful amounts of money.
Right. Good. Okay. Sorry to interrupt. Go ahead.
No, you're good. You're good. So we have a forward value of the stock, which we're going to take our nickel off. So 233.35, or sorry, and add the nickel to 233.35. I get 233.40. Mm-hmm. And then I'm going to subtract the dividend of 129. So this means our forward value at expiration is expected to be 232.11. So
Okay.
we want to keep that 232.11 in our head, and that's what that S number is going to be. That's the forward value of stock.
Okay.
So we take that and we'll subtract this strike. The strike right here, I was looking at the 232.50. So minus 232.50, and I get negative 39 cents.
Okay.
So negative 39 cents is going to be what this side of the equation is. And so that means my call minus my put is going to equal negative 39 cents. Well, my call is $1.62. My put is $2.01. That's negative 39 cents.
Yeah. So write that on the left side of the equation, negative 39. So that's where they become equal. Okay. And I'm going to show you something. I'm going to share my screen in a second and show it a little bit differently. So those values, that number, negative 39 on the left, negative 39 on the right, those always have to be equal. Now, we're not going to argue about a penny here, a penny there. What the Citadels of the world do, and when I say Citadel, they are an electronic market maker. They make two-sided markets in the marketplace. They provide a very important function. They keep those relationships in sync so that they never really get out of sync. If they do, and for instance, on Mark's equation, if the left side of the equation became some smaller number, let's say it was 0, right? And the other side was negative 39. They're going to do that spread all day long as much as they possibly can do relative to their capital. And their capital is about I'm guessing $20 billion. So they will do that until the cows come home, as we like to say, because it is a natural arb. Why is that true? It's important to know this. If you hold, let's say you do this spread, you're long the call, short the put. Okay. And I'm going to share my screen now, Mark, if that's okay.
Yeah, please.
Okay. So let's pretend if you're, I hope you can see my screen. Can you see it? Okay. And feel free to ask questions. If you're long the call, short the put, which I have up here. It's called synthetic long stock. What is the natural hedge for synthetic long stock? Okay. It's selling the stock. Since I have a one lot, I would do 100 shares. So if I add 100 shares to this, okay, all my deltas go away and I have a perfect hedge. At expiration, I'm going to take the stock out again. At expiration, this will expire into long stock, this long call, short put, right? Short puts give me long stock, long calls give me long stock. So if I'm above the strike, I'm going to get it from the call. If I'm below the strike, I'm going to sign on the put and get my long stock that way. If I have a short stock position, what do? They net out to zero, right? Nothing's left. What did I gain? I gained the difference between the synthetic that I bought or got for a credit versus what I'm paying for the stock or receiving for the stock. If I can get a sizable enough difference, that is a natural arbitrage, a natural hedge that can't be taken away from you, except for if the dividend changes, right? Or interest rates change. That will throw off that calculation in the interim. I hope that all makes sense. Did I say that correctly?
No, that's great. And I think you highlighted right there at the end a really important part about how if the dividend changes or the interest rate changes, and that can be pretty significant. And I think that's actually some good advanced topics to put that to really get into how those dividends and interest rate changes. That's where you can see some really funky things happen with something that's a relatively simple equation at its most basic.
Yeah. Let me stop sharing so we can see you better and your board better here real quick. But oops, sorry. I didn't hit the stop share button. Okay. So yeah, it's super important. And I can tell you a real life story. We were the DPMs and I don't remember the stock exactly, but we had long-term customers or institutions buying puts from us. So I was selling them and selling us calls. So they kept doing that combo. So I kept getting short puts, long calls. And what did I have to do to hedge that? I sold stock. So I was getting to this big, what we call a reversal, way out in time. So there's a lot of dividends that would come to pass with that expiration. It might have been at the time 300 days to expiration. So there's a lot of dividends that can happen, right? So, long after the first 1,000 or so that I did, I decided to say, wait a minute, this, when something's too good to be true, it's probably right. It probably is too good to be true. And it was, because someone had information that I didn't have and that they were going to raise the dividend. Right.
So let's walk through exactly like why raising the dividend hurts you.
Go ahead. Do it, Mark.
Because raising the dividend, that sounds great. Give me, I want more dividends. But remember, your long deltas, like you get upside exposure like the stock from your call, not from your stock. You are not a stockholder here. You only hold calls. You are short stock. And when you're short stock, you don't collect the dividend, you pay the dividend.
Mm-hmm.
The holder of the short stock is responsible for paying the dividend to the long stockholder. So when you were selling those puts, buying those calls, you might have been pricing in $1 dividend. All of a sudden, if you have to pay out a $2 dividend, that's twice as much as you expected. Any edge that you had was completely wiped away by that.
Right. Not to mention, if you go through several dividends, not just one, but two at a higher dividend, now you're going to pay it again because you've computed your carry at that lower dividend level for many dividends. And it's in the point to make here too, just to be clear, is that Mark did this on one dividend only. If he went out in time and did his example, he'd have to include all of those dividends in his calculation, every one that we would pass along the way, right? Interest rates would be greater as well. So that would have to be computed out to the number of days that he chose. Okay.
Well, and I actually have this as a note to talk about as an advanced topic, but you can even get fancier. What if that dividend starts to become material? McDonald's is paying $1.29 a quarter. That adds up to a little over $5 a year. That growth of that dividend then becomes an amount of capital that requires its own interest rate to discount back on.
Right. Right. Yep. Absolutely. So this is a relationship. Look at it, I would say for retail traders, um, probably it's not a spread that you're going to do necessarily. You might do the synthetic long part of it with options and buy a protective put if you're bullish. That's a great strategy for not using the stock and saving some margin money. Okay, that totally makes sense. But you're not going to be in the business of doing the synthetic long, selling stock and making money off of it.